Good morning from London. I'm Anna Edwards alongside Guy Johnson and Valerie Teitel. We're an hour away from the opening trade. Here's what you need to know. Washington says it's finalised a trade truce with Beijing, while President Trump hints at a, quote, big India agreement in the works. The EU says it's ready for a trade deal, but all options remain on the table. Global stocks head for a record after the Nasdaq closes at another all-time high on optimism over US rate cuts. Plus, the US says it will drop its Section 899 so-called revenge tax after reaching a deal with G7 allies.
And let's check in on the markets just ahead of the equity open in just an hour's time. S&P futures hovering around a record high. Euro Stoxx 50 playing catch up to yesterday's late rally in the U.S. and Euro dollar, that rally has stalled around 117. The countdown to the opening trade starts right now.
Just signed with China. We're not going to make deals with everybody. Some we're just going to send them a letter, say thank you very much. You're going to pay 25, 35, 45%.
We are preparing for the possibility that no satisfactory agreement is reached. We will defend the European interest as needed. In short, all options remain on the table.
Good morning. Friday morning. Is the market correctly pricing risk right now? I think that's a debate that we need to be having over the next couple of hours. You've got rate cuts driving US markets, equity markets to fresh record highs. You've got this belief that trade deals are going to get done. Didn't sound like trade deals were going to get done. Listening to Donald Trump yesterday, some people are just going to get letters. There's going to be no deal. This is just going to be a letter. It's going to arrive on the doormat. There you go. 25, 30, 40, 50. I don't know what the number's ultimately going to be, but it could be high. So is the market correctly pricing risk? And is the European Union going to get the deal it hopes for? The Germans are looking for an idea that maybe they can get a carve-out similar to the UK in terms of cars. I suspect the Friedrich Merz is going to be disappointed on that one. But at the moment, the glass feels half full when it comes to markets. Rates are going to get cut. Deals are going to get done.
Yeah, it's as if we've come through a big geopolitical point of tension and we forgot the points of tension that we were trading on before that, which was all to do with tariffs. On the tariffs, then, we've had progress on the China side, progress on the EU side, or at least commentary, if not progress. So on the China side, just to reiterate we were hearing there, that the White House is saying, and Howard Lutnick telling Bloomberg TV, that they've signed a trade truce. This is more detail, more signatures around the Geneva Accord, it seems to be. Yep. It doesn't seem as if it deals with the substantive future relationship between these two countries.
That's already in the price. This is already in the price.
12th.
I thought that's what we'd already had done. This is just this little signature.
Yeah, but I mean, my eye goes straight to the dollar. Is the dollar reacting positively to the supposed good news? And it's done really nothing this morning. So I don't think the markets are necessarily believing these 10 imminent deals that Lutnick was talking about yesterday.
Well, what makes up a deal? We talked about this a number of times on the programme. We talked about this when we got the UK deal. That was the first one, and we didn't learn much about other geographies from that, but we did learn that there is a lot of ambiguity about what it takes to get to the end of a deal. Might these just be framework arrangements, and then a lot of conversation carries on afterwards?
They could also be letters arriving on the doormat.
Yes,
telling you that that's the rate that you're going to be paying.
Sure, the EU does not want a letter on the doormat saying 50%.
Who do you send the letter to? Is my question.
That's a great question.
So there we are. But the rate cut story is dominant. That's the idea at the moment, that nothing matters. The Fed's going to knock all the rough edges off all of this sort of stuff by cutting rates aggressively.
Yes.
Do I believe that as well?
Right. Well, we'll come to that in a moment, shall we? The markets conversation. But let me go to the revenge tax, because you were talking about watching the dollar, and some people were watching all kinds of US assets. On this news flow that came out yesterday from Scott Bessent, Treasury Secretary, saying we've removed the 899 revenge tax. That's not what he calls it, but that was the section of the big beautiful bill that had been dubbed a revenge tax. And Scott Bessent saying they've removed it because they've come to a deal with the G7 on taxation on US companies, which is really interesting. So the argument from the US is that the G7 has agreed to not impose Pillar 2 OECD tax on US businesses, which you'll remember was the rule that was brought in to stop US companies and others from moving profits around the world to find lowest tax jurisdictions. But we haven't heard much from Europe on that. We've just heard it from the US side, which I think is interesting. But the dollar didn't move on that either.
Yeah, no, it didn't. I thought it was interesting that even the Treasury Secretary is directing things going into the congressional bill. He seems to does have a lot of power on that level, but it did surprise me that it was at his direction that this is being unwound.
I just think it's nice that they've all read it now. that clearly I'm not sure everybody read it the first time
It's
around.
big. It took a long time.
Well, yes, it is a big, beautiful bill, and this was buried in a very small section of it.
It does make me wonder, though, the point of this revenge was about the OECD Pillar 2 taxes, but also the digital services taxes. Now, if the G7 is saying we'll give ground on the OECD Pillar 2, does that mean they will stand their ground on digital services taxes and not have to... Anyway, we'll see. There's a lot still to come on this one.
I suspect there's going to be a point
And
of
I'm probably more
disagreement.
interested in this tax story than anybody else around the... well, anywhere on a Friday morning.
Well, there's another side to the story, which is actually there's a procedural issue now within Congress, which is causing problems potentially for the big, beautiful bill, which is getting pushed further out. And at some point, we're going to get a funding problem. And it feels like the summer's going to be a little more tense than we originally anticipated. And I'm just wondering whether or not there's talk that basically the parliamentarian in Congress is saying you cannot push forward with this big chunk. It relates to healthcare. There's talk of overruling the parliamentarian, who basically is the kind of the rule setter. But if it proceeds as is at the moment, it's just further delays in terms of the process.
Right. You know, we thought this bill was going to be on the desk of the president by July 4th. That was their self-imposed deadline, hitting a big snag on Medicare spending, and this Senate parliamentarian essentially smacking down the cuts to Medicaid, having to do with the fact this is a reconciliation bill. This is not a bill that is it's supposed to have new laws put into it. So it's kind of a procedural smackdown of a bit of the one big, beautiful bill.
But it just delays it.
Exactly.
And that's the problem. So we start coming up against funding problems. We start, and the longer it goes on, the more Wall Street's got to worry about it.
And the more we have to wait for the confirmation of those tax cuts that we know that Wall Street so desperately wants. But let's turn to the markets. It's a Friday. Let's sum up the week. Equity markets have been strong around the world. U.S. equity markets hovering near record highs. The S&P 500 index looks like it could close at a record high if this move in the futures holds. The dollar has paused its 4-day decline, but it's definitely been a brutal move for the U.S. dollar. And treasuries are now on a 3-week winning streak. A lot of that due to the dovish Fed shift expected.
So every morning, Val and I have a little debate about kind of what's happening in the markets, and Val's like, record highs, it's great. And I go, yeah, but look at it in euro pricing. So yeah, the S&P's up by 2.68% this week. If you're a euro investor, it's up by 1.26%. I shaved off a big chunk of your gains this week. I'm just going to point out the DAX is up by 2.6%. So in euro terms, the DAX has outperformed the S&P this week.
But we also have to keep an eye on the U.S. data that we got yesterday. It was a bit mixed. We didn't see initial jobless claims rising. I think that's what most people in the market were worried about. We did see a continued rise in continuous claims, which I think is worrying some, that maybe there's some labor hoarding going on in the market. The GDP revisions did come in soft when it came to consumer spending on services, and maybe that's something will be reflected in the PCE data today, maybe a soft services inflation figure.
I mean, really interested in the softening of some of this hard data out of the US, or softening of all kinds of data out of the US, because is it the case then that we don't necessarily need to assume a very much more dovish Fed chair next year to get to lots of rate cuts? Exactly. It's the point we were kind of throwing around yesterday as well. You can find a path to more rate cuts, it seems, and the market is increasingly doing that based on the data and based on the Fed dovish voices that we've been hearing.
Are you ignoring the stagflation argument if you do that? I.e., inflation could be picking up.
Yes, and that's what Powell has been justifying his patience
and keeps talking about it. He firmly believes that could be a significant risk.
Yeah, and the GDP revisions did kind of point to stagflation. You had the price index being revised up and then consumption being revised lower.
Yeah, market doesn't want to hear the word stagflation at the moment. Not even slightly. What have we got coming up on the show? Camilla Asabaroga, EFG Asset Management Fixed Income Portfolio Manager, is going to be joining us. Christine Kunby-Nielsen, Danske Bank FX Analyst. North of 120 euro dollar. That's her call. She's sticking to it. Sophie Hoon, BNP Paribas Asset Management Cross Asset Portfolio Manager, is going to be joining us. And a little later, Steve Bliss is going to be joining us, TS Lombard's Chief US Economist. We'll get his take on all of what we've just been discussing.
Absolutely. Lots to discuss with him, including, well, we might look ahead to US PCE. That's something that's on the agenda for today. What else do we have? An EU Leaders Summit, of course. We talked about some of the lines coming out of Europe on that, on the trade front, but there have been other topics on the agenda. We'll get an update on the latest. Those talks continue today. We'll also get US PCE data, as I mentioned. We'll get US stress test results as well from the banking sector. Guy.
Not very stressful, I think, probably. And you do wonder whether the story around what's happening with the supplemental leverage ratio will be a factor in that as well. What else do you need to know this Friday morning? Nike shares, I'm going to call it Nike shares, popping after hours thanks to a brighter outlook, hinting that CEO Elliott Hill's turnaround plan is starting to work, at least in the mind of investors. Sales were still expected to dip this quarter, but not as much as before, i.e. the worst is behind us. Hill says it is time to turn the page with better earnings ahead. Nike is also tackling about $1 billion in expected tariff costs by raising some prices and cutting back on manufacturing in China. Bloomberg has learned that BBVA is leaning towards proceeding with the takeover offer for Banco Sabadell. We're told it's sounding out investors to see if they'll still back the deal after Spain said the lenders wouldn't be allowed to fully merge for several years. And in the UK, Bloomberg understands that Prime Minister Keir Starmer has agreed to significantly pare back a £5 billion welfare cut to fend off a rebellion by his own party, or significant numbers of members of his own party, parliamentary party. We're told Starmer has agreed to soften the blow of a sweeping welfare overhaul meant to move people off benefits and back to work. More than 120 Labour lawmakers had threatened to vote down the plans. This is significant for a number of different reasons, one of which is Starmer's 1 year in office next week. Struggling with a significant rebellion, probably the biggest rebellion he is likely to see around welfare spending cuts, but he has caved. And the reason he's caved is because the scale of the rebellion is getting bigger and bigger and bigger. But it also I think it calls into question a number of things, one of which is our tax is going to have to go higher in the UK. Yep. And I think that is something that I think we're going to be talking about.
Just lumping the problem onto Rachel Reeves, isn't he?
Yeah, here you go. Here's the problem. Your problem, Treasury.
Find more cuts, please.
Yeah. But I think it's just political expediency now, at the cost of tax hikes for the economy later. But also, I just think this NATO spending story just folds back into it as well. All of Europe is struggling with this. Is it guns or butter? Is it welfare or is it defence spending? Spain has said it is welfare. The UK actually, in some ways, by this decision, is pointing towards that as well.
And the bond market is paying attention to that. Last few days, we have seen bear steepening of most major European bond curves. It hasn't been brutal, but it's definitely been noticeable that we're seeing these long-end yields rise. I guess it's this expectation they're going to fund this extra defence spending with debt some way, somehow.
Right, yeah, so you're saying that the long end of the gilt market is focused on this then, Valerie, because that's interesting, because the short end, it doesn't seem as if this cut through, maybe that's as you would expect. It's very much focused on rate cuts, and rate cuts are still coming, seems to be the market's assumption, and so they managed to. But this is also the second time he's had to climb down. The first time wasn't over a big number; it was winter fuel payments. But we still don't know how that's going to be paid for. So this is just, as you say, another item on her agenda to try and fund.
Non-DOMS feels like it's next. Like some sort of withdrawal. The pressure is mounting, and at some point there's going to have to be some. It looks like there's going to be some sort of change. The table is being set for that. How far that goes, I don't know. But again, I think that probably has become a cost at this point, but I don't know that. But it just sets the stage for tax cuts in the autumn. That's where we're going. That seems to be the narrative. Sorry, tax hikes, not tax cuts. That would be nice.
That was some wishful
in the United States, maybe tax cuts are coming. Maybe.
Oh, yes, hopefully.
Coming up on the programme, we'll get back to some of the corporate news today that we've been discussing as well. We'll check if Nike's optimism will propel European sportswear stocks, or if investors will be sweating the numbers. I didn't write that, just said it. Plus, Bloomberg opinion columnist. It was nice, though. Max Hastings will join us. And Guy was just referencing the complicated trade-offs. Are they trade-offs? Is that the right way to think of it, between guns and butter? We will talk about the NATO summit. Max Hastings, Bloomberg opinion columnist, will join us to do just that. Up next, Donald Trump isn't backing down in his criticism of the Fed chair. The White House put out a statement yesterday saying that there were no imminent plans to make any early announcement on a new Fed chair, but he still was pretty vocal in his criticism of Jerome Powell. We will get a take on that once again in these markets. If you have questions, if you want to get involved in this conversation, IB plus BBTV Go is the function on the Bloomberg terminal. This is Bloomberg.
The president's already won. It's a great distraction of headlines. I personally don't think he's going to name anybody too early, because right now he's in the catbird seat of blaming without accountability, which is classic Trump playbook.
I'd never heard of catbirds. Apparently, it's a grouping of songbirds, but every day is a school day, clearly. Apollo Global Management President Jim Zelter on the next Fed chair pick. That's as President Trump ramps up his criticism of Jerome Powell, who he's repeatedly accused of being too slow, on cutting rates, and he's said a whole lot worse. Valerie Teitel here with her thoughts. He's kept up the criticism, but the White House did put out a statement, Valerie, yesterday saying that they weren't going to be, there's no urgency. They're not naming anybody soon.
Look, but it has been almost every day this week he has said something negative about Jerome Powell. I, for one, was very interested in our own economist, Anna Wang. She put out a piece overnight about what she's assuming about her front runner for a Fed chair pick, and it is Kevin Hassett. That's who she has in her mind as the most likely Fed chair to replace Jerome Powell. But interestingly, she does place Christopher Waller ahead of Treasury Secretary Scott Bessent. And I think this is interesting because Christopher Waller has been a vocal member of the federal board at the moment, calling for a July cut. And remember, he was maybe joined in this view for a July cut by Michelle Bowman. So there are two current Fed governors talking about the possibility of a July cut. And Anna, I want to wonder if this is setting up for possibly two dissents at the July meeting if the Fed does go and hold interest rates. And does that weaken Powell's hold on the FOMC board already? So maybe politics are going to be placing a big impact on the FOMC meeting in July, which is just in under a month's time. But it's already having a market impact. Take a look at how the 10-year Treasury has traded in the last 3 weeks. It's on a 3-week winning streak in terms of the 10-year yield, down 25 basis points in those 15 sessions.
Val, I find it fascinating that she put Hassett first. The reason for that is that some would suggest that Hassett doesn't want the job, so it'll be interesting to see whether or not he ultimately ends up taking it if offered. Let's carry on the conversation. Camila Astabarega, Senior Portfolio Manager at EFG Asset Management, joins us around the table. Good morning.
Good morning.
Are yields coming lower? Are rates going to get cut?
I think that there will be a cut rate. I mean, it's interesting because so far this year we have had 60 billion of tariff, revenues, and they have not been seen in reality in inflation. Yep. So you could argue that Powell is sitting and saying, well, actually, this all inflationary pressure that people were expecting from tariffs increase is not being really seen in the economy. Although we have
he's saying it's coming, though.
It's coming,
it comes later in the year.
Exactly, and that's it. Is he going to wait until you see a real impact in the economy, which we already have seen in a slowdown? I mean, the U.S. economy is slowing down, that's for sure. It's how much and if that actually will come in the inflation that we haven't seen so far. So I think that there will be a rate cut, but I think that the market is already pricing that in.
So what I find peculiar at the moment is that credit is telling me that everything's good, tight, everything's amazing, yet the Treasury market's saying rate cuts might be needed. And walk me through that one.
So it's interesting because if you look more from a philosophical perspective, since COVID, governments have increased so much debt. They have increased debt and their fiscal deficit, and they need nominal growth to pay for that, deficit. Mm-hmm. Yep. So if growth slows down, they need the Fed or exactly. They either need inflation or they need to cut rates to keep that growth coming. So I understand why there's so much pressure on poor Powell for him to cut rates, because there is this slowdown happening. But if it's a slowdown together with cut rates, then it might continue the spreads tight and everything being big, beautiful, But if not, then it's like pass the parcel, that game with kids, and at some point the music will stop and you're like, end up with a big surprise.
And the point that the music is going to stop would be a long end sell-off, correct?
Correct, exactly. Or very bad economic real data. That's, I think, that.
What are the chances of, Trump maybe picking someone, an Uber dove, as Fed chair, and the market just rejecting it, and you already getting that long end sell-off even before the Fed chair sits down, saying, dovish policy isn't necessarily going to work for the long end of this bond curve?
I feel it's like a good scapegoat always to blame the Fed, So I think it has been his game, and I think it might continue being so. But if you look at all the curves, they all have steepened as well. I mean, central banks are not buying treasuries or bonds anymore. There's no QE. So they're letting the market run its course. And in Germany, of course, with the higher spending for defense, that, of course, has pushed Bunds also curve steeper.
Can I ask you about 899, the section of the Big Beautiful Bill that had a lot of focus in this part of the world, or rather just outside America generally, because a lot of investors were concerned, or big businesses were concerned about their ability to invest, or at least the tax implications of them investing in the United States. What impact is this going to have on appetite for treasuries? And I know your focus may be more on the corporate side, but just your thinking as to how big a story this is, that Treasury Secretary Besant is saying that this is going away.
Yes, exactly. I think, personally, it's more a political tool, this, rather than actually, something so real. Because for me, it would be very hard for Trump to actually put this and give less incentive for foreigners to invest in the U.S. Like, that's his main thing, what he stands for. So I would be very surprised if they go ahead with this.
Because a lot of people said it played into that sort of sell America trade that we were talking about earlier this year. And the fact that we haven't seen much of a rally in the dollar or much of a rally in treasuries, I mean, there's a bit, but not a huge amount, certainly in the dollar there's a bit. The fact we haven't seen very much of that, does that mean that those fears were overdone, or does it mean that the damage is done? And actually, you can remove 899, but the fact that you're thinking about it was enough.
I agree. I think that this uncertainty is not healthy for anybody. It creates uncertainty too for corporates to invest, but also for investors to invest in the credit market. But I personally, as I said, I believe it's not going to be a major impact. It's just more a political tool. But it is interesting that you say, I mean, the net trading of the dollar is at the moment very low. I mean, the euro has appreciated 10% this year. That's definitely been deflationary, and that's why also the curve has steepened in the Bund curve. And, I mean, I think that there is, more in the medium term, still a dollar depreciation, but in the short term, because of the technicals, I believe that we could see, and we have seen a bit of a bounce.
Can I ask you about defence spending in Europe?
Yeah.
Can Europe afford the kind of numbers that it's talking about right now? The UK is having this debate today. Starmer's going to have to climb down over a big welfare spending bill.
Yeah.
The UK needs to continue to spend on welfare. Yes, it's telling us that it's also going to be spending 5%, whatever the number's going to be, on defence over a long period of time.
Yeah.
Can Europe afford its welfare bill and its defence bill at the same time without raising significantly more debt?
I mean, they will have to raise debt, that's for sure. It's how much of that will go into real economic growth, I mean, there's still a lot of uncertainty regarding how much defense goes into actual growth and nominal GDP growth. If it goes, then it's fine. Then, you create a bit of our inflation, a bit of growth that can pay for that debt, for that increase in debt. But if it doesn't, which is still a lot of people are second guessing that derivative in the market, then of course, fiscal deficits are just going to keep growing and growing. And for me, that's the main risk that I see in the markets at the moment, is too much debt in the sovereign space. I mean, it wouldn't be surprising to see sometimes, credits having a better rating than the sovereigns. We have seen it in emerging markets, and we could see it with maybe, I don't know, Apple, Meta, maybe potentially trading.
Is the bond market mispricing these worries over the deficit?
A lot of people are just looking at yields and not at spreads. I believe spreads are so tight. Could they go tighter for a long time? Yes. Again, it's the same thing as passing the parcel. But for me, as an investor, the main thing is always to understand what's my upside versus my downside. And in fixed income, we always have a different symmetry of upside downsides versus equity. But really, it's important to now is for that extra bit of yield, for that extra bit, I have to take a lot more risk. Is it worth it or not? And that's where we should really focus on, fundamentals in the end.
Camilla, thank you very much. Thanks for joining us. Good to speak to you. Camilla Astaburuaga, Senior Portfolio Manager at EFG Asset Management. Perfect voice to have to digest some of the big picture macro themes around fixed income and how that translates into the corporate space as well. Coming up on the programme, the European Union says it's prepared for all eventualities if trade talks with the United States break down. Of course, we're heading towards that early July deadline, July 9th, very much in focus. The EU saying all options are still on the table. Some divisions, though, certainly emerging within the European Union, according to our reporting, around those who don't want the perfect to become the enemy of the good when it comes to a trade deal with the United States. We'll get the details next. This is Bloomberg. 7:30 here in London. 30 minutes until the start of Friday's equity trading session, nearly at the end of the week. One more day to go. Let's have a look at the futures picture. It looks pretty buoyant, actually, certainly in the French market, up by 0.6%. Maybe the FTSE once again a little bit of a laggard. Valerie and Guy, interesting things that we think that we have in mind as we think about where this session goes. Of course, we get some data out of the United States later on today. The conversation around the Fed continues. The weakening data, the changing Fed narrative, comments from the White House, all of that in the mix, along with plenty of US politics.
Who cares? Buy stocks.
That's what the market's saying.
That's what the market is saying. Ignore all the risks, buy stocks.
Yeah, we take a look at the
buy tech stocks as well. Sorry, the bond market.
Yes, NASDAQ 100 has hit a record high many times this week, Guy. But take a look at the European bond market open. We're seeing a slight rally across the curve, maybe undoing some of that bear steepening that's taken place in the last 2 days due to this extra defense spending that will somehow need to be financed by debt. At least that's what the bond market is worried about.
Absolutely, which takes us to the European Union, the summit that has just taken place. The EU says it is prepared for all eventualities in its trade negotiations with the United States, including a breakdown in talks as the bloc goes through the latest proposals from the White House. There's been a summit in Brussels to discuss.
We are ready for a deal. At the same time, we are preparing for the possibility that no satisfactory agreement is reached. This is why we consulted on a rebalancing list. And we will defend the European interest as needed. In short, all options remain on the table.
All options remain on the table. Let's go to Brussels. Bloomberg's correspondent, Oliver Crook, is to be found there. There seems to be quite significant divergence within the leadership of Europe about what kind of a deal is desired here. Some want a quick deal, some just want no deal, some want a deal that includes things like autos and a carve-out. That's what the Germans are looking for. But does Europe have a clear idea of what it's actually looking for?
I think everybody wants a deal, Guy. The question is to what degree and what degree of asymmetry is going to be acceptable for any trade deal with the United States. And we should say that, Guy, we are, having these discussions at the European leader level a week and a half before the United States is set to impose 50% tariffs on the EU on July the 9th. That is the deadline that's coming, that's, sort of fast approaching here. And that was the discussion around the table. And we heard a number of different views. As you alluded to, Guy, we heard from Friedrich Merz, the new Chancellor of Germany. This is his first European Leaders Summit, saying, and I'll quote directly, it's better to go fast and simple than slow and highly complicated. We need to reach a result quickly. We've all agreed on that. There is no disagreement there at all. We've heard similar commentary, and we understand that that is sort of the position of Giorgia Meloni, who is more interested in getting a deal done quickly and moving on to the next thing. So there is a sort of idea that this sort of pragmatism is really going to try to win the day here as you approach the deadline. But that being said, there are still a lot of reports in the reporting that we're doing that the U.S. is demanding a lot of asymmetrical things within the trade deal, that it is a little bit too imbalanced at this stage, which is why we're still hearing, even from the leaders who want to get a deal done very quickly, that they are ready to retaliate in case they cannot find a satisfactory deal. Everything sort of being considered and being equal, going in a week and a half from now, I doubt very much that we're going to get a comprehensive trade deal with the United States. Likely what is going to happen, and this is what our reporting is telling us from the leaders that we're speaking to, is that they'll potentially get a framework agreement, buy a little bit more runway to get that final negotiation done a little bit further down, to kick the can down the road a little bit further.
Meanwhile, Macron in France is urging against accepting a skewed deal. Is that right?
Yeah, that's right. But it seems that even he is softening a little bit. We heard from his commissioner, the French commissioner, Stéphane Séjourné. He's the man here in Brussels who is in charge of negotiating things at the industrial level and competitiveness, saying that basically a 10% tariff, that ring tariff around the United States, and that is, I think, what everybody is envisioning, and even the best case scenario that the United States is going to keep that 10% tariff, that would garner retaliation. Now, for Macron's perspective, it seems that he is softening a little bit. That being said, he's also been talking about the fact that basically in the sort of Trump psychology that Europe cannot afford to really appear weak, cannot afford to appear naive, and that will actually in the long term harm them. The question is, how much is the Trump administration willing to push on the EU? What appetite do they have to escalate the situation in the Europeans, vice versa? There's also this big question about digital taxes. This is one of the big questions. This is one of the big points that the White House is pushing. I spoke to the competition commissioner. This is the person who's in charge of fining Apple, Google, Meta, all of these companies, and asked her if it was on the table, if the DMA, the Digital Markets Act, could be something that the Europeans are willing to bring to the table in order to get a trade deal. Have a listen.
We do not challenge the United States on how they implement the rules or how they adopt the regulation. I think that we deserve respect the same way. And I think that the Digital Markets Act is a very good proof of how we can be much more effective, much quicker, and much cheaper when implementing a well-functioning market in the digital context. So I'm very proud of what we do.
So the DMA and the regulation of U.S. tech companies is apparently off the table. But I think the broader context here, no matter what happens with the deal, is the Europeans are thinking very closely about how they can, going forward, de-risk themselves from the U.S. economy, de-risk themselves to a certain degree from a very unpredictable Donald Trump. The ways that they're doing that is they're also talking about the Mercosur deal, getting that forward. The French have sort of come on board with this, a big trade deal with South America, and also talking about an alternative to the World Trade Organization that they think is broadly dysfunctional. So those are the sort of longer-term goals as they push forward for that short-term goal of reaching a trade deal with the United States in the next week and a half.
Ollie, thanks very much. Bloomberg's Oliver Crook in Brussels. That takes us nicely onto a conversation about foreign exchange markets that starts with Eurodollar. Let's have a look at where we are on that particular currency, the single currency then. Pretty flat, actually, this morning against the US dollar. Still messing with that 117 mark, it seems. We went through it yesterday, as Guy rightly pointed out, around this time. In fact, earlier than this, yesterday morning. But we don't seem to have held that level. But certainly a lot of the conversation is about how quickly, there we are, 117, how quickly we get up to 120 and then beyond. Let's get the views of Kirstine Kuhnby-Nelson, who joins us, currency and commodities analyst at Danske Bank. Kirstine, good morning. Thanks for joining us. A lot of the focus is, OK, 117, how quickly we get to 120. I think you've got a target that takes us to next spring of 122. I mean, that seems, is that ambitious enough? How strong could the euro get?
I think it really depends on the direction of travel. I think we have to be humble in this period of time. We're seeing some very significant movements in Eurodollar. I mean, it's at the strongest level now year to date. So maybe 122 isn't even enough. I think it really, from our point of view, from the research point of view, it segments that we expect a weaker dollar going forward. And also, I think we see a lot of this political uncertainty, but our forecast in so many ways also reflects a structural shift when we're looking at the European versus the US economy.
We were talking earlier in the programme, Kirstine, about Section 899 of the Big Beautiful Bill, and some had suggested that as Treasury Secretary Scott Bessent had removed this, says he's removing this from the bill, Section 899, that would put upward pressure on some US assets. Is that something that's going to limit the euro's gains, or do you think perhaps that ship has sailed and it's not going to matter much for markets?
I think if we look more broadly on this big, beautiful bill, I think something that I'm at least focusing a lot on is how markets react to this in terms of the debt perspective, really focusing on that we're seeing these kind of ballooning US deficits. There's a lot of focus on, OK, will this actually be something that can create more stress in the Treasury market? So I think that's at least what I'm really paying attention to, that, OK, sure, this is expansionary fiscal policy, but will it actually create trouble in terms of looking at the Treasury market and can actually end up becoming a more of an issue for the dollar, I would say, more structurally.
Kirstine, on your view that euro hits 121 by year end, what's the main driver for that call? Is it rate differentials? Is it growth differentials? Is it this reallocation trade that we've talked so much about? What's the main push for it to get to 121 by year end?
Yeah, as you said, I think it's a combination of factors, but I think definitely this capital rotation out of the U.S. is an important thing. And then also when we're just looking at some of the data that we're getting from the U.S. economy, when we're looking at labor supply, for example, we're really seeing the labor force and really seeing labor supply shrinking to an extent that actually even started before the Trump administration. So I think, and on the other hand, we have on the euro area side, we're really seeing this increase in Germany in terms of fiscal spending. So we're seeing, I think, a new divergence in terms of structural growth outlooks. So on the one hand, this political uncertainty, this uncertainty that is really coupled with the US right now, and structural growth drivers, primarily, for example, driven by a productivity slowdown in the US and by structural growth also set to slow down the coming years.
All right, so you mentioned there some things about the U.S. economic growth. How much weight are you putting on this recent discussion about a new Fed chair pick? Do you think maybe perhaps a more dovish shift to the Fed board would be another tailwind for euro to reach new highs this year?
I think it's a difficult question. I think markets are really putting focus on, at least I think that's what we've been seeing here the past couple of days in terms of Trump mentioning that he would look for an early appointment, possibly, and looking at 3 to 4 different members. I think that markets, I think they always get this when we see a shift in the Fed. Okay, what would this mean for markets? It definitely creates some unease, that we're seeing a more dovish Fed. It also really alters, I think, some of the influence in terms of not the independence of the Fed, but at least what are markets expecting on how the Fed will react. I think it can end up being a tailwind for euro-dollar. If we see a dovish Fed, I mean, tariff concerns have eased here over the past month. So I think that's also something that could reignite it. But I think it's too soon to say in terms of a new Fed chair. I would more put focus on what we're seeing right now from the Board of Governors.
Kirsten, good morning. It's Guy. Is the Euro story... Is the European story real? Europe seems to believe it can do it all at the moment. Germany can spend more money, maybe France can spend some more money on defence. But at the same time, we can continue to sort of fund the welfare bill as it is. And it seems that Europe is setting itself up for attention, or at least there is an underlying lie about what Europe is doing. And I wonder whether the market is prepared at some point to try and find out what reality is. Are we going to see tax hikes? Are we going to see more debt? Is that something that global investors are really comfortable with in the long term?
I think it's interesting when looking at the German perspective. One thing where at least Germany really stands out is that they've been running this very conservative approach to fiscal policy. Yeah. It's also one of the countries that has a really relatively really low debt to GDP ratio, which also means there's a lot more room. So I think really when we've seen this German economy stagnate over the past many years, that can be more a paradigm shift. But I think it's important, and as you mentioned, to be cautious. I think there's really built in some optimism. Let's see how much they can deliver on that. We still need to see how the spending will be allocated. But I think it marks an important turning point. Also, just thinking of how austerity really has been a big thing in Germany.
What do you think about the pound right now? Looks like tax hikes are coming. Looks like rate cuts are coming as well. But it does seem as if the UK economy is going to continue to struggle under a higher tax burden and potentially higher rates for longer. Do I buy sterling on the back of that, or is that really the right trade?
Yeah, I think we're in for a weaker pound going forward. As you mentioned, there are some tentative signs already of the UK economy struggle. We also saw it on the latest monthly GDP prints. One thing I think that's also important, the domestic drivers, of course, we're seeing still high inflation, but we're seeing the economy weakening to a larger extent. But the pound also rarely performs, at least against the euro, rarely performs well in an environment that's really characterized by elevated uncertainty. So I would definitely, I'm for a weaker sterling from here on out.
Kirsten, interesting to hear that. Kirsten Kubi-Nelson, FX strategist at Danske Bank, joining us on the FX outlook. So important right now for the macro top-down picture for these markets. We're going to talk about the bottom-up story next, though. Sportswear stocks in focus this morning. Nike's after-hours surge, very strong, despite disappointing earnings. How's that going to read across into the European names this morning? Your stocks to watch, your shoes to watch, is next. This is Bloomberg. Welcome back. We've got some slightly hotter French inflation data dropping on the Bloomberg terminal as we speak. So the harmonised number month-on-month comes through at 0.4. Remember, it was negative 0.2 last time round. It was expected at 0.2. We've got a hotter number than anticipated. That takes the harmonised number on a year-on-year basis to 0.8, which is still well below where you would hope to be if you were the ECB, i.e. the target is 2%. The euro's picked up a little bit on the back of this, but not by much. We are pretty much flat, as you can see on the screen in front of you. So, yeah, lukewarm data coming out of France, but slightly warmer than it was previously.
Slightly warmer than expected. I feel immune to slightly warmer, given that we've come from a land a couple of years ago where, you know, you were looking at 6%, and now we're lower than 1%. But anyway, I know that's not where the market's thinking is. So we'll watch what the euro is doing with that in mind. And let's talk about the broader picture in markets. We're joined for 3 minutes on the markets with our Markets Live executive editor, Mark Cudmore. Mark, good morning. So it does seem as if there are some risk-positive stories at the margin then. You can look at the 899 news from the United States as an example of that. And even some of the weakness in the data out of the United States has been fed through into the lower rates narrative. So I suppose from that perspective, the push higher in stocks makes sense. Is there too much complacency, though, in your view?
I'm struggling with this market at the moment. Every input would seem bullish at the margin. As you say, yields are much lower, and it's not just because of softer data, but it's also because we're putting pressure on easier monetary policy from the US administration that is feeding through to Fed officials who are clearly feeling that and advocating for cuts at the front end. So we've got easier rates. We've got a massive fiscal tailwind globally. Of course, NATO has promised immense levels of spending over the next 10 years out of Europe. We're expecting the big, beautiful bill out of the US. We've got China spending, so a global fiscal tailwind. The trade promises this week out of the US have generally been promising. We've been told that US and China have got further along in terms of their agreement. We're told 10 more deals are coming soon. We've got a weaker dollar. We've got better geopolitics. We've got the removal of the 899 threat. We've got the SLR adjustment. Literally, it's just been an immense wall of bullish factors. And yet the S&P 500 is really, really struggling to make that marginal nudge higher to get close at a record high again, despite being so close all week. And it's the price action's kind of worrying me. I love bull markets that climb the wall of worry. I love when everyone's panicked out there, and yet the market inputs are good. That was the scenarios you had last year, which is why I was bullish most of last year. Right now, it feels like we're getting stuck on the escalator of promise. We're failing to go higher despite all the inputs being good.
The escalator of promise. I like that phrase, Mark. But let's, I guess, maybe tamper the excitement. What are some negative risks on the horizon?
Well, I think that given the kind of optimism and promises out there and the kind of communication we've had from officials around the world, I think we're really teed up for disappointment. So I think trade, the US keeps on saying we're going to get 10 deals any moment soon, and that US-China continues to finalize the confirmation of the agreement that they'd previously made. But so therefore, I think that trade might be disappointing with that deadline approaching. I think the big, beautiful bill, you know, is going to struggle to get passed by next week on that arbitrary set deadline. So there's disappointment there. I think we all know that NATO defense spending is probably promises that won't be fulfilled. But I think also it's a story that's going to take a long time to kind of run through. And I think that with yields having fallen so far from here, I think there's risk that we might get more concerned on yields on the upside from now. We've played the disinflationary theme. And I'm not saying that yields have bottomed out yet. I have no particular catalyst or reason for them to suddenly jump next week. But if I had to say where the next big move in yields is, it's likely to be yields higher, particularly at the long end, as we continue to have growing fiscal concerns and as inflation comes back on the radar with the increased costs of global trade due to US tariffs.
Thank you very much, Mark. Bloomberg Markets Live executive editor Mark Cudmore with us there to talk us through some of the themes on his mind and that of the Markets Live team. You can get all their thoughts. MLIV Go is the function to use. And he was just referencing, actually, Mark was just referencing some of the confirmation of the confirmation of the confirmation of a deal between China and the US, which seems to be the world we're in right now. And we've got that coming through from China. So we heard from the US, Howard Lutnick, yesterday, that there is an agreement of more detail around the previous deal, which was about rare earths and semis between China and the US. Well, now we have a red headline coming from the Chinese side. They say they have confirmed their trade framework details with the United States. It doesn't move the conversation on necessarily. We still don't know what happens after August, early August, but that's where we are on the China narrative.
Is this good news?
I mean, equity futures seem to like it.
Well, it's not bad, I guess, is it?
It's not negative.
Unless you're underwhelmed, and then maybe it is bad. Let's leave some time for Joe Easton and his rundown of the stocks we're watching this morning. Joe?
Morning, Anna. So we are watching the sportswear sector today. Given we had Nike results last night, the company saw its shares rally in the post-market, up around 11% for Nike's stock. Now, the company did actually report a sales decline, but it wasn't as bad as most analysts expected. And that stock has come down a lot this year as well. So it's kind of a bit of a relief in that, rather than it being a really strong report. But mostly it was around the outlook, wasn't as bad as expected. So a lot of these sportswear stocks potentially going to see a bit of a relief today. Puma, take a look at that one. We're down 50% already year to date, so there could be some relief. We have had a couple of profit warnings out of that sector already this year, including Puma. JD Sports has been weak as well, mostly tied to Nike. So potentially, as I say, this is going to be a relief for that sector. Then over in utilities, we've got news for Centrica. This from the Financial Times, saying the company could be looking to buy a stake in the Sizewell C nuclear project over in Suffolk here in England. And that stock, we can see, has risen around 300% over the past 5 years. But there's a couple of mixed calls on this, given they would be spending more than £1 billion to do the deal, but it's also one of the big clean energy projects in the UK and potentially positive in terms of a sales viewpoint as well. We later did get some comments out from Bank of America strategists today, downgrading utilities following the big rallies that we've seen in stocks like this. So potentially that could be a negative, but keep an eye on Centrica in the UK today. Then finally, gold miners. Keeping my eye on these because we have seen a bit of a drop down in the gold price overnight, only around 1%, but it is one of the biggest daily declines we've seen for a while. And those stocks, the gold miners, the precious metals miners, have had decent runs, particularly the London ones, so Fresnillo, Hochschild Mining, all of the ones exposed to precious metals have done well, and the weaker gold price today potentially going to weigh on the sector. So keep an eye on those in the basic resources sector this morning.
OK, we certainly will. Joe, thank you very much for that. And worth remembering, basic resources was by far and away the best performing sector yesterday for Europe. So it was up by nearly 4%, actually, for the sector. So some real strong performance coming through in some of the mining stocks as we wonder how strong we are at the start of the European trading day. US futures pushing a little bit higher.
Yeah, fresh records. Here we go. We keep pushing up and up and up. What is a catalyst to get stocks lower? Because the problem with all of this is that you sit in a situation where the dip that we saw earlier this year got bought aggressively, and that mindset appears to be what is driving everything. And at some point, also institutional managers, the FOMO must be getting bigger.
This move is probably painful for some of those who are underexposed.
Right. Yeah, lots to talk about then. Coming up on the programme, we will bring you the last trading day of the session. This is Bloomberg.
Friday morning, good morning. A couple of minutes to go until the opening trade. Let's talk about yesterday's session, particularly over in the United States. Up and to the right seems to be the phrase. As you can see, we started there, we finished there. That is the narrative. We've got to price in a little bit to Europe this morning. We captured some of it, but definitely not all of it. I'd say futures are up, but not that much this morning, Val. Are we seeing a little tentativeness maybe going into the weekend? It's also the end of the month as well.
Hey, we're adding on to the risk on moves. It's been a positive week for the equity market on both sides of the Atlantic. Euro Stoxx 50 futures up 0.8%. Some of that is the catch-up trade to the strong close on Wall Street yesterday. Also, DAX futures outperforming slightly, up nearly 0.9%. Anna, what stocks are on our radar this morning?
Yeah, it's interesting. The FTSE 100 set to underperform because I do see basic resources are actually higher, copper, iron ore and the likes. We'll watch the mining sector once again. We'll focus on sportswear makers as well. Nike delivering numbers last night. Their year-long sales decline is easing, with the company expecting a smaller sales drop in the current quarter than anticipated. How will that play for some of those European competitors, the likes of Adidas and Puma in focus? BBVA is something we're going to be watching as well. The Spanish bank is considering proceeding with its takeover offer for Sabadel, despite Spain putting some pretty onerous conditions in place. So we'll continue to watch how that one develops. And Akzo Nobel is also in focus for us. JSW has agreed to buy Akzo Nobel's India unit, or up to 75% of it, for about 1.4 billion euros, including debt. So we'll watch how that one performs. So, Guy, we're watching these individual companies, but we're also bigger picture, thinking about the evolving Fed narrative and the trade picture as we work our way towards the start of July.
Absolutely. The market loves it. The market certainly seems to be taking this as a positive risk-on story. That is where we are this morning as we head into the opening trade this Friday morning. Remember, there's a bit of month-end factoring in as well that you need to think about. But let's look at a market that is expected to open, let's call it circa 1% up. A little shy of that. London maybe a little bit of a laggard, but we'll see exactly what it delivers on the upside. Maybe 2-3 tenths of 1% is what we can expect early on. London's underperformed a little bit recently. after actually some quite positive noises around it. But the Stoxx 600 is now up by 0.4%, as is the IBEX this morning. We'll keep an eye on the banking sector over in Spain. But the Stoxx 600 up by, 0.4%. The CAC opens by 0.7%, so the Stoxx 600 starts to climb. The DAX is up by 0.9%. So a much more positive picture emerging in Germany this morning. But Europe maybe joining the party a little bit this morning, Val.
Look, it does seem like we are seeing those Nike results of late last night having an impact across European shares. JD Sports, the biggest mover to the upside, up nearly 5.5%. You join that with Puma's move 3.5% to the upside. Both of those two stocks have the biggest upside swing on the Stoxx 600s. When it comes to your sector, it's no surprise that retail is outperforming on the back of that as well.
Yeah, absolutely. So the consumer products and services does seem to be where the best performance is coming through, or where at least within that sector is doing well. Adidas, I think, also up by 2%. Even sticking to some of the luxury names, perhaps, they go a little bit higher. Maybe that's the broader narrative. It seems that the sectors that are sensitive to trade may be getting a boost today. Just, not necessarily any firm headlines to trade around, but we do have some of the car makers and the car parts manufacturers moving a little bit higher. That's the best performing sector in Europe right now, up by 1.5% on autos and parts. It would seem technology not having a bad day either. Utilities seems to be one of the few sectors in negative territory.
506 stocks up, 70 down. And the market is definitely on the front foot this morning.
Glass half full.
Glass half full seems to be the narrative. What I will say, though, is that the recent rally has not been delivered on great volume. So how convincing is it in terms of who is participating and how narrow it is? I read an interesting report yesterday talking about the technicals around what we're seeing in the States, just how narrow the market is. And it needs to broaden out if some of the technical sort of factors are going to be continued on the positive front foot nature that we've seen of late. So yeah, I think this is a market that what feels like it wants to go higher, but to Mark Cumber's point, given the news flow, should it be even higher? And you just kind of wonder whether or not actually the market is
so
as
you're
glass.
Bullish guy? Are you bullish here?
No, I'm actually. No. Let's not go too far.
We've discussed it with Greg before how that doesn't fit the accent.
We
apparently,
should be higher. That's what he just said.
Yeah,
some of our audience.
It should be even higher than it is. So therefore, by extension, that is bearish.
Let's talk to Sophie Hun, portfolio manager and strategist at BNP Paribas Asset Management. Sophie, very good morning. Thank you for joining us. So do you think that, there's a lot of complacency in these markets? There are lots of things to worry about, and yet stocks go higher? Or, to the point that we're sort of making there, do you think that given all of the at-the-margin positive news flow, maybe stocks should be even higher than they are?
I think there's a very short-term focus on the latest narrative, some kind of trade deal or potentially trade extension beyond the 9th of July, but also how the economic developments supposedly are not that bad. But at the moment, I think there's a disconnect between markets, which want to price the bullish narrative, and the macro data, which are pointing towards risk to the downside. And I think it's quite interesting.
Yeah, I mean, that macro data to the downside, though, being taken as a positive, though, isn't it? Because it reinforces the need for rate cuts. Thinking about the trade narrative there, and we've got ourselves excited about that, it would seem, this morning. What do you think markets are really expecting from July 9th? Are we just expecting some, I don't know, maybe 10, maybe fewer, framework deals that don't have very much detail in them, and then a whole lot of talking from there? And crucially, what will tariff rates look like in the meantime? Are we assuming they stay where they are for a very long time?
I think if you look at what you were talking about, the open on European stocks, could be a follow-up of what happened in the US. I think it's also pricing out potentially that tariff above 10%, which might be right or wrong. But what we could have beyond the 9th of July could be an extension of the tariff, where they are, more negotiation, because I think for now it's been China and 10 other countries, but what about the others? So I think there hasn't been enough time to negotiate. We could have an extension, which is going to feed into a bullish narrative for equities. But the question is, when are we going to have the reality check?
Yeah, Sophie, I guess the thing that I'm having a hard time dealing with is an extension already priced into the market? It's such a hard thing to understand, but it does seem like to be, at least for the market's point of view, they're not that jittery about this deadline extension. Do you think that there is an assumption that we're just going to get another 90-day extension?
I think what's not priced at this point is potentially pricing out the stagflation fears. So if you look for now, the gap between where tariffs were and where they are now, it's been a massive increase. And yet the impact on inflation print have been quite muted. So I don't know if you follow this $1 billion project, Alberto Cavallo. So he's basically monitoring price indices on a daily basis, monitoring for retailers. And for now, the price increase has been really muted. So does it mean that front loading so far have been feeding into inflation and that's why it's quite muted? Or really tariff are going to be taken, like the hit is going to be taken by corporates? And in the end, there's not going to be massive economic impact.
That just echoes what Chair Powell has been saying a lot, that we just don't know where in the supply chain the pain is going to fall. Does it fall on the consumer? Does it fall on the margins? Or is it a whole mix of all of the above?
Yeah, you could argue, though, if it doesn't end up hitting the consumer, it just means more is left on the company's margins to the downside if the companies are eating it. So maybe you can argue that it's perhaps negative for equities if these price increases don't make it to the consumer. Just painting out some nice pictures for our audience here, Guy.
Just checking, just to make sure that things are as they should be. What does the dollar do to the outlook? Say we get to 120, say we get to 125. How does that change the narrative, particularly for European investors?
So if you look at euro dollar, I think everyone is bullish now. It wasn't the case 6 months ago where dollar bears were feeling very lonely. I think at this point what could play in favor of euro is like further FX hedging flows. When European investors could say, do I really want exposure to US dollar at this point? Might not, so I'm going to start hedging more. Yeah. And if the Fed is actually going to cut, then the cost of currency hedging is going to go down. And then the second thing is, if you look at the year-to-date inflows into European equities, it's only 1/3 of the outflows we got in Ukraine, so potentially much more upside going forward at a time where you have new thematics developing in Europe, right?
Okay. A lot of investors are still long the United States.
Yes.
That unwind continues. Does the euro accelerate that? Why should I be... If I believe long-term the US markets are going to do well, do I invest but on a hedge basis? How do I factor into my investment decisions what I do with the currency? At the moment, this week, for instance, the S&P's up 2.5%, but if I'm a euro investor, it's up 1.2%. How big a headwind is the euro going to be to any investments that I think about in the United States?
I think you're going to have European investors that are going to start to decrease the exposure to US dollar. Like if you think from a valuation perspective, dollar is a sell from here. So I think we're going to continue seeing European investors decreasing the overweight into US assets, both on equities and bonds. And in US equities, it's going to be much more thematic driven. So AI, for example, it's not going to be as broad-based as before. And then diversify and put more into European equities with defense or the banking sector.
Sophie, what's your thinking on the defence sector in Europe right now? Because it attracted a lot of attention, but a lot of people sitting in this chair have suggested that some of the names are looking expensive. But if we get dips, do they just get bought because of the overall thematic narrative? Or does the market stop believing that it can all be delivered at some point? What are you thinking?
So our equity PMs internally are still very positive on the defense thematic. They think it's a multi-year investment opportunity that we're going to get. I hear the worries about like how multiple expansions have gone. In terms of earnings expectation, I think it's twice the market at this point for the next 3 years. So there's worries about that, but I think it's one of the themes you can basically highlight in Europe. I think people will continue to buy on dips because it's something that is going to continue on a multi-year basis.
All right, so we haven't hit peak defense yet for Europe. What's your view on U.S. tech stocks, though? You did mention that if European investors were to dip their toes into U.S. assets, they'd do it more on a specific basis. Do you think there's still a lot of tailwinds for AI stocks?
So I think it's quite interesting, your question and what you said earlier about like more optimism. So if you look at earnings momentum in the U.S., you look at upgrades versus downgrades, it's been picking up across the board. But in the US, it's across sectors, but more particularly in the IT sector. So with this renewed interest in AI, but also an upgrade of earnings expectation. So on that, I think US stocks are going to benefit. But if you look at Asian stocks and the performance of Summit stocks, also Korean stocks, there's been this broadening out of AI boom. And I think it's going to be much more beneficial across the board than this concentration in the US.
Sophie, great to see you. Thanks for stopping by to see us. We always appreciate it. Sophie Hyun, Portfolio Manager and Strategies at BNP Paribas Asset Management. Core 6 looks like this. Let's take a quick look at what some of the leading stocks in Europe are doing this morning. And as you can see, there is an awful lot of green on the screen. Schneider is up over 3.5%. Even Nestlé, which is a defensive stock, is up by 0.5%. Luxury is doing relatively well. Tech is doing relatively well. Novo's up by 1.3%. As I say, there's a lot of green. What else is there that we should be watching? Joe Easton has the details.
A lot of green in the sportswear sector today, Guy. In particular, we've got Adidas gaining, Puma as well. Puma up almost 5%. JD Sports gaining nearly 7%. One of the best performers in Europe today, all coming from Nike. I'm going to go with Nike because I am British rather than Nike, but that one is boosting the entire sector. So JD, one of the biggest partners of Nike in the US and in the UK as well. So getting that boost there in terms of the better than expected sales update, or at least the guidance from Nike last night. So we're seeing significant gains in those. Adidas needs a boost as well, that one. And Puma, that was down 50% on a one-year basis heading into this report. So getting a good little read across from the Nike results coming through last night. Then in terms of the gold miners, looking a little bit softer as expected, given the drop down that we saw in the precious metals prices overnight. But again, these stocks have done really well. They've rallied over the past year or so, given the big move higher we've seen in gold. So gold only a few $100 away from its record high still. So still, they're getting a big boost. But for today, we are seeing little losses with gold set for its second weekly loss. So it was down last week, it's down this week, and that's feeding through into those stocks today. Then utilities, we had these on the radar, firstly because of this news around Centrica potentially going to buy a stake in this big new nuclear project in the UK. That's worth more than £1 billion in terms of what they might spend on that. But then we had Bank of America as well, the strategist coming out and downgrading the sector today, so turning negative. This is a valuation call, though. It's all about the big rally, and they think that's probably gone a bit too far now. It's rallied given the defensive stance that people have taken in the markets over the past few months. So they come down in terms of those stocks. Over in Spain, we've got Indra Sistemas. Now, this is described as a hidden defence gem by analysts at Morgan Stanley. It was a software company, but it's pivoted towards defence, kind of getting on trend, on vogue in terms of what they're doing with their business. So they've shifted to defence, and as we know, all the defence stocks have rallied. Morgan Stanley says you should be buying that one as a way to buy into the defence rally. And then finally, in the UK, we've got Pearson. This is the education company, does all the exams and other university education. It's getting a boost because it has got an upgrade at BNP Paribas. They say that a recent sell-off linked to a profit warning from an Australian peer has actually sent the stock too low. So they think you should be buying the dip in Pearson, and Pearson stock rising 2.3% in London this morning.
Thank you very much, Joe. Joe Easton from our equities team. Coming up, see, I'm listening to Joe. We'll talk about a big US sportswear maker. It's soaring in after-hours trade as its turnaround plan finally seems to be paying off. How is this playing out? Well, it's playing out positively for European sportswear manufacturers as well, the likes of Adidas and Puma. We will get back to that story in a moment. This is Bloomberg. Welcome back to the opening trade. 17 minutes into our European session, and it's green. It's greener than perhaps we anticipated on some of these markets, up by nearly 1% on the CAC 40. It seems that trade narratives and the Fed narrative helping to lift market sentiment a little bit towards new highs for global stocks. Let's talk about one stock that was doing really well after hours. That's Nike. Shares of the sportswear manufacturer going higher thanks to a brighter outlook, hinting that the CEO Elliott Hill's turnaround plan is starting to work. Sales are still expected to a dip this quarter, but less than had been anticipated. Really interesting commentary on the supply chain as well for a consumer company. Let's talk to our Bloomberg consumer reporter, Sonia Vint, who has been covering this and looking at the read across into the rest of other European names. Sonia, nice to have you with us. Is this the start of a turnaround then for this business?
Well, it could be. I mean, it's clear the quarter was quite painful. It was one of the worst performances, quarterly performances Nike had in recent years. But it was better than the market has feared, as we can also see in the stock price reaction. And the CEO also said that the worst could be behind Nike now, and things could start improving from now on as his turnaround strategy is starting to take effect. So he's basically trying to undo the missteps of the predecessor. So that includes improving the partnership with wholesale partners, to backtrack that misstep in direct-to-consumer sales, which made it lose market share to rivals On and Hoka. It's also doing partnerships like with Kim Kardashian that could help bring shoppers back to the brand. And it's clearing out excess inventory to make space for new innovations, new designs. So it could be the start of a turnaround, but of course we have to see whether those changes will really take a hold in the coming quarters now.
Sonia, I think many were looking at these Nike results as perhaps a macro indicator of how a big multinational corporation is dealing with tariffs, given Nike has so much exposure to Vietnam. Do we get much color on how they're dealing with the tariff impact?
Well, it's clear that the tariffs are a big challenge, and Nike said that the cost headwinds from the tariffs could be $1 billion in fiscal 2026. So it's definitely a challenge. Nike is trying to address that with the strategy of reallocating its production from China to other countries. So currently it has around 16% of its US footwear produced in China, and it plans to bring that down to a high single-digit percentage over the coming quarters. So that could help mitigate some of the headwinds. It's also looking at corporate cost cuts and also how much it can pass on price hikes in certain items for consumers. So that could kind of help to cushion the impact, but the main priority is also to reignite the brand heat of Nike. The CEO is trying to do that with a renewed focus on core sports areas, especially running. And the hope is that the new products are going to excite consumers again. We saw some early good signs on that. So the new running shoes, they had a warm reception, and also new upcoming launches like the Air Max Phenomena has seen some online buzz going on. So if that energy translates into sales as well, then that could help it to power through the headwinds that we're seeing from tariffs.
Great stuff, Sonia. Thank you very much indeed. Sonia Vind on what is happening with Nike. I'm going to go with Nike, though I guess if you're going to go with the Greek goddess of victory, it should probably be Nike.
Do you guys have this fight every earnings season? Oh,
it feels like it, yeah. I am concerned that Anna has decided to go to the dark side.
I think the UK moved on, Guy. I
don't care. No. I haven't. Michael Masika's sitting next to me. He's going to save me. Bloomberg senior strategist. We're going to talk about banks, though. Much more sensible subjects. European banks have had a great run. You're concerned that maybe that's beginning to become a little bit more nuanced?
Yes. So we've seen over the past 5 years the stellar returns that they had. I mean, we're talking some of those banks had like our 1,000% in total return. Talking about Sabadel, BPM, all those banks that are involved in M&A especially. But even like UniCredit, which is like the consolidator of the sector, is up like 800% for the past 5 years in total return again. So those stocks, they've been returning a ton of cash to shareholders through buybacks, through dividends, because they had the opportunity to do so, because their earnings have been growing at a very, very fast pace. And now we're seeing, obviously, this is slowing down slightly. The ECB has, cut pretty much everything it can cut in terms of interest rates. So we're going to start to see those feeding into earnings with like less growth. And obviously, we can't expect banks to be the driver of the European market like they have been over the past 5 years.
Is that going to be what's the theme that we're trading around in Europe, do you think, then, Michael? You've written a piece this morning that says we're looking for a fresh catalyst. I mean, the market seems to have got itself excited about the possibility of trade deals this morning because we've heard some news lines around China and the US and a little bit of a holding statement on Europe. If we are returning to thinking post the Iran-Israel conflict, if we're returning to think about trade, does that sound like markets up to you?
Well, let's say the tariff issue has been a little bit forgotten over the past few weeks. We're having a deadline next month, and we still don't know what it's going to be, especially for Europe. So yeah, maybe we have like a very positive catalyst in the sense that if there's a deal with China, this is also positive for Europe. But at the same time, I mean, we've seen how long it takes in Europe to get a deal done. I mean, you know, we live in a country which had like a lot of trouble finding its deal with Europe. So we're still waiting to see what's going to happen with the US on that front. It's a big uncertainty.
Maybe it's going to be the U.S.-European deal that's going to take ages instead of the U.S.-China one, which I think many of us thought was the deal that was going to take years. I guess the question really is for European stocks. We have all this good news priced in. You know, what is really going to be the next kicker? Because I mean, it's never been so good for European stocks at the moment. And really, they've only outperformed the U.S. by 3%, Guy? Maybe.
Do you want to currency adjust that?
Do you want to maybe you can. But I don't know. I just you would have thought that with all of these tailwinds around for Europe, that they would be, you know, outperforming a bit more.
Yes, they had outperformed a bit more up until recently, where we had like a big catch up from the Nasdaq and all the big tech. At the moment, what we're seeing is the demand for European assets is still strong. It doesn't mean that Europe is going to outperform the US for a long period of time, but at least investors expect them to bring the same type of returns as the US over the next year or so, maybe longer than that. And that's where the catalyst is in terms of like where Europe is going. If there's like an appetite for European assets and some assets that are being brought back to Europe, all those assets that have been invested in the US for so many years, you will have like some push on the European markets.
Do you think that maybe an international investor is looking at how long this BBVA Sabadel deal has taken to get approved, and then approved with all of these, red lines that might eventually stop the merger, seeing that as a big headwind for the fact that Europe really does need banking consolidation. It needs more liquid capital markets, and it seems like it is just not being an easy time.
Yeah, we've had consolidation in the banking sector. It's not enough, for sure, and we need more. But, the red tape in Europe is the red tape in Europe, and it's always getting to the point where you get those hurdles. Is that deal going to happen? Maybe, maybe not. It's a problem for an investor, for sure. And that's where Europe is always having trouble to, keep the momentum going, because there's always a moment when they kind of mess things up. And I hope that's not that type of moment, but we'll see.
That's the technical term. Michael, thank you very much for joining us. Bloomberg senior strategist Michael Masika, with thoughts on the markets and where we find another catalyst, or where these markets head from here. Let's have a quick look at some of the lines coming out of China. We had news overnight from the US side that there was further agreement around the previously agreed Geneva agenda on trade between China and the United States. Well, we've just been hearing from the foreign ministry in China, and they've also been talking about things to do with Europe, so the China-European story moving a little. Wang is planning to visit Europe June 30th to July 6th. I mean, what stands out to me is just the timing of that, coming right before July 9th. It's pretty soon, and it's coming just before we get, supposedly, some deals with the US on trade.
To your point about Europe, if Europe doesn't get a deal, does this sort of outflow out of the United States into European equity markets, which we've seen a little bit of, does that just stop? How cataclysmic would that be for this narrative?
Yeah, what is the baseline assumption? Are you just assuming that the current tariffs stay, if that's the case, as conversations continue? We'll continue to get soundings from the market. We'll be back with more shortly. This is Bloomberg. This is the opening trade. It is Friday morning, 30 minutes into a session that is turning increasingly positive. We're up by 1.3% on the CAC 40. So we do seem to have found optimism in the trade conversation and in the fact that the Fed narrative, perhaps, that has led to higher stocks this morning. And US futures, Valerie, pointing a little bit higher. Take us through some of the data story coming through from the US.
Yeah, we got a lot of US data yesterday. It did tell a few different narratives, so I thought it would be pertinent to go through them. The big one was on jobless claims. So you've seen a consistent rise in continuing claims. It actually hit a cycle high yesterday. Now, this is happening while we have initial jobless claims coming in lower than expected. So it's really begging the question of whether there's labor hoarding going on in the U.S. economy, that maybe U.S. companies are treating their labor differently after the lessons of COVID. We also got GDP revisions for the fourth quarter. It was the final print of GDP for the first quarter. We did see a revision down, a lot of that having to do with a lower reading on personal consumption. I think this is pertinent, Anna, because we saw this revision down, especially when it came to services spending. And I think that could be a theme that we could see in the PCE data today. Bloomberg Economics expects a weak reading due to the fact we are assuming that services inflation will be a big drag down and it'll offset any tariff-induced goods inflation on the other side.
Let's talk about this in a little bit more detail. The perfect person sitting next to us, Steve Blitz, is here, TS Lombard's chief U.S. economist. Val, running through the data in terms of what we're seeing. There is some ambiguity in the data coming out of the United States at the moment. What is your overall impression? An economy that's slowing, but not that fast? An economy that's slowing fast enough to deliver rate cuts? What is the overall picture?
I think the economy is slowing enough to give us a little bit of a rate cut. I think we'll have.
What does that mean?
Well, it means 25, 50 basis points. It doesn't mean 100 basis points. We're not like we were in September. Where
but just one or a series of back-to-back cuts?
Well, you know, the answer that everybody hates, it depends. But I think,
you're an economist.
Yes. But I think it's definitely a number that, look, I think that the economy's slowing down. The problem with the data, with income, especially spending data, is that you have a tremendous amount of distortions, right? Because you had a lot of early buying by business as well as households. You had to jump in auto sales to get ahead of the tariffs. Now you're seeing a slowdown. So to say that's a slowdown is really just you had a lot of pre-buying. So you're not, you know, real imports were up 50% in the first quarter.
Yep.
You're not going to be up another 50%. In fact, you're going to get a big pullback on that, right? So when you add all that up, the employment numbers really become critical, and then the employment numbers are somewhat distorted because you're losing labor because of deportations and this type of thing. So it's very difficult, but when you look at claims and you see them pulling up, when you look at coincident indicators like TSA
travel
data, that's negative year over year, even though the economy's higher. So these are signs that are telling you that the economy is fracturing, you know, on the margins. And now that inflation seems to be in the closer to 2 than 3, there is a little room to cut. But, you know, the Fed Powell is concerned about the coming hikes, right? From the
inflation hikes.
The inflation hikes, and he doesn't want to get caught like he did the last time.
How are you viewing when exactly this tariff-induced inflation hits the economy? And could perhaps we're maybe underestimating the amount of deflation that could come from services inputs? Because services makes up 2/3 of CPI. You know, goods is only 1/3. Could it be completely outweighed?
Well, I think the service side, though, is fairly constant, right? So so the real volatility in CPI, one of the reasons you take food and energy out, comes from the goods side, right? And the other thing is the good news on U.S. inflation for the past 30 years was that CPI goods ex food and energy was 0 from 1990 to 2019. So it is a critical in that sort of 2% side to get back to that importation of deflation or disinflation, however you want to think of it. Now, going forward, the thing about the price hikes that I think people aren't particularly focused on is that this is a tax on tariffs or a tax on earnings, right? Because this is how the U.S. trade deficit is created, right? And so firms have a number of ways to figure this out. The weaker employment is currently, the less likely we're going to see hikes going forward, right? Because they're not going to be able to pass through these prices. And firms have the option of readjusting payroll to keep their margins where they are. And no one seems to really want to internalize that part of it. It's like, well, it's either margins or prices or some mix, but there's also a payroll adjustment that's out there.
No, that's interesting. So you're saying that if the labor market weakens, we're almost less likely to then see tariff-induced inflation off the back of that.
Right. So, which is why I think that the June payroll number is pretty important, right? Because if June payrolls look like the last few months and continues to show a slowdown, you really have to lose confidence over how much of a tariff price hikes you're going to see in August, September, October, which is when everyone thinks the CPI numbers are going to jump higher.
Do you have a number on NFP next Thursday that could tempt this July cut that we've seen growing in speculation?
I think anything under 50,000, 65,000 would do that. Yep. Because 75 to 125 is considered neutral in terms of payroll growth against population growth, right? So anytime if you're above that, they get a little concerned. If you got a 200,000 number, you're not getting a cut in July, but you know what? You're not getting a cut in September either, because that means that the economy's strong enough that all these price hikes are going to come through, and all the things Powell's concerned about.
The survey number's 120, the whisper number's 111. So we're not at those kind of very low levels yet.
No, but those are the kind of low levels that you think would prompt those cuts. Can I dwell on the inflation subject for a little bit, Steve? Because
wherever you want.
Thank you very much. Because I'm really interested in this, the propensity of businesses to put up prices, or the confidence with which they would do that or not. Because we've just come through a period where businesses had to relearn what inflation is all about and re-understand the level of pricing power they had. And they had a lot of it. And they did okay with that. And they pushed up prices, and we know what happened elsewhere in the economy. And that lesson is still very recent. And I wonder if that has an impact on businesses when they're looking at this and the inflation that, the way the tariffs could weigh on their businesses, and maybe they're more likely to try and pass them on.
Well, they're going to try, but that's what I think is very interesting, right? Because you've got this front loading of inventory, right? And what people are learning, guys like myself who go way back to the high inflation, we understand that firms price not against inventory costs, but they price against the cost, the projected replacement cost of inventory, right? Now, when you have low inflation, that's kind of a meaningless difference. But when you have inflation, like we saw in COVID, it becomes meaningful. So now you've got a lot of firms with a lot of inventory pre-tariff, but they know they're going to replace that at a tariffed price.
Yeah.
So now they're trying to figure that out. So I think firms are in the process right now of figuring out just how much they have to eat, how much in terms of margin, their suppliers, their exporters, the whole chain.
Yes.
Or how much they can just pass forward or not. And we're in this discovery, and that's why in this coming quarter, this is where all this stuff is going to start to show up. And so that's why I think it's a higher volatility quarter that's coming than what the market is priced.
Back to the weakness of the data, I suppose. We know the market has been rethinking Fed cuts and coming around to the idea that we get more of those. That's what we've been talking about this week, partly due to weakening data maybe, but also partly due to the Fed chair conversation and the fact that President Trump keeps pushing back against Powell. How important to the market do you think it should be, this conversation about when a new chair is announced?
The media loves it and the market loves it, but I don't really think it really matters all that much, honestly. I think when the next Fed chair is announced, and we're going to know this in the fall, right? Because he or she has to be approved by Congress. His term doesn't end until May. And so it's not like this conversation is going to get a little bit closer. And I think if anything, given that Trump's going to want somebody who's going to bend to his will, which really means that it's going to be a Fed chair that's going to bend to the needs of Treasury, right, in terms of financing government, that the longer end of the curve is going to do worse than the shorter end of the curve. You know, he's mistaken, Powell. Trump is mistaken to believe that if you just cut the short end, all rates are going to come off. That's true if the Fed's cutting the short end because there's a recession or a real slowdown in growth. But if they're cutting it and the economy is still running at 150, 125,000 in payroll every month, the long end of this market is going to do worse. And especially so, remember that 4.5% of GDP is what the U.S. imports in capital every year. So the non-dollar investor is critical. Yeah. And that same gross surplus of funds around the world to come in, because everyone else is doing things, it starts to go away.
Harder to control the long end. We've talked about that a number of times.
Yeah, and maybe this dovish Fed chair pick could really blow up in Trump's face if we do get this long end bear steepening that could make financing costs for the U.S. even worse.
Steve, thank you very much. Thank you for joining us. Steve Litz, TS Lombard, Chief US Economist. Always a pleasure to have you in the studio. Thanks for joining us. Next week, Bloomberg is live at the ECB Forum on Central Banking in Sintra. So a little bit more of a European flavour, perhaps, but still thinking about these global inflation and growth themes. Join us in Sintra, Portugal, on Tuesday as Bloomberg hosts a policy panel with the world's top central bankers. That's at 2:30 p.m. London time on the 1st of July. Coming up on the programme, just how historic was this week's NATO summit? Bloomberg opinion columnist and author Max Hastings joins us next. This is Bloomberg.
44 minutes into the equity market session, European equities are on the front foot. I tell you what's not on the front foot, though, is the defence sector. It is weakening up. Hensoldt down by nearly 5% this morning. Rheinmetall is down by nearly 4%. Babcock's down. Leonardo is softer as well. So the defence trade is definitely coming off. This after a week when we've really focused on what the defence sector is going to do next and the spending numbers that are being delivered out of Europe. NATO leaders this week agreeing to increase defence spending to 5% of GDP, with President Trump branding it the most unified and productive summit in history. But in private, EU leaders have reportedly made coded criticism of Spain's refusal to accept that 5% goal. Joining us now is Bloomberg opinion columnist Max Hastings, author, of course, of histories including Vietnam, an epic tragedy and abyss, the Cuban Missile Crisis. There are others, and they are definitely worth reading. Max, very nice for you to join us this morning. Was it a productive summit?
It was a very productive summit in that they prevented Donald Trump from throwing all the NATO toys out of the pram. Nobody at the summit was being honest. That everybody gave this terrific cheer for Donald Trump, spooned on the flattery in a fashion that nobody's seen, I don't think, in the history of any NATO summit going back to the 1940s. But it had to be done because this appears to be the only way to deal with this American president. The summit had two objectives. One was to prevent Trump from breaking up NATO, and the second was to prevent him from pulling the plug on Ukraine. And for the moment, both those objectives appear to have been fulfilled. But the price was a loss of self-respect, because almost every European leader present said things he didn't for a moment believe. He said that he supported the American strikes on Iran, which most European leaders do not. And I'm afraid I'm an old skeptic about the numbers that have been produced about getting to 5% of GDP spending on defense by 2035. They're all going to be retired by then, which suits them down to the ground. I don't believe that's going to happen. But if it keeps Donald Trump on side, even for a week, it's worth it.
OK. Yes, a lot written, and you have around the use of flattery at that summit. Really interesting piece there. But thinking about the 5% commitment, Max, and the reality of it, I mean, I know that we will continue to have conversations about where is this money going to come from. But if this were to become more existential for more European countries, isn't there a sense that maybe the bond markets in that situation might be more forgiving?
Some countries, including Spain, have made plain that they have no intention of making any serious increase in military spending. Other countries, the Germans, have made enormous pledges. The British are doing our best. But all the national exchequers, Europe is having a very rough time economically. And I personally have serious doubts whether any of these terrific projections for spending are going to be met. It's very difficult for European politicians to get European voters to sign up to defence spending. Now, those of us who are sort of in the business and who take strategy and defence very seriously are appalled that for many years, the one thing Donald Trump's been dead right about is that Europe has had a free ride on defence. And that time is over because we're now dealing with a newly assertive and aggressive Russia. But it's still very hard politically to get European voters to take this seriously.
Max, do you not think that that's a big risk for these European nations, given they've promised 5%? Maybe if they don't get there, you know, in 3 years' time, that's only going to irk the U.S. president even more?
Well, by then, everybody's rather hoping that this American president will have gone. They're playing for time. It's a game. I don't think it's a very honourable game, but maybe it's the only game in town. Maybe it's what they've got to do. But governments have got to say one thing. Governments have got to make the supportive noises to Trump. They've got to flatter Trump. People like me and you do not have to do that. So I think we should try and tell the truth, even if our politicians are not.
Max, is it guns or butter? And if it is guns or butter, how you're making the point that at some point the reality is going to come through, and we need to be making that clear. You've got a story on the front pages of the UK newspapers this morning talking about the fact that Keir Starmer is having to climb down on welfare spending. That's the butter. But he's also in the same week delivered an outlook for defence spending that is sharply higher. In terms of how it plays out on the butter side, is there a danger that ultimately we do see political ructions in Europe because politicians have to make cuts and the tension is going to rise? I'm just wondering how you think this plays out on either side of the fence and whether or not actually we are heading to more political chaos in Europe as a result of some of the commitments that are being made.
I think you're absolutely right that very difficult dilemmas are ahead because it's very hard to take an optimistic view about public finances, not merely in Britain, but in Europe generally. Public finances are going to be under enormous pressure, not just this year, but for years to come. The German economy, we know, has got very serious structural problems. And in the midst of all this, to tell voters that they've got to give up on important, huge sums of money, many billions of money that at the moment goes on welfare and health and so on, for defence is very tough. So I think that there are going to be some very difficult choices. And the hardest part is to get anybody involved to tell the truth to voters about how serious the risk from Russia is, and to tell voters that they're going to have to give up on some other stuff in order to defend ourselves seriously, because most of the armed forces of Europe at the moment are in no fit state to fight anybody. And that, of course, is one of the things that's so embarrassing about Ukraine. But if Donald Trump pulls the plug on arms supplies to Ukraine, we, the Europeans, simply do not have the means to replace those lost weapons. We are almost naked.
Yes, and Max, I know that Europeans probably, the legacy or the history tells us recently at least, they would prefer to fight Russia with sanctions. We've seen sanction package after sanction package. Any sense that any of this is making a difference in bringing Russia to any kind of negotiation at all? Is it possible to find a sanctions package that would do that, Max?
There is absolutely no doubt that tougher sanctions, sanctions are already making a serious impact on the Russian economy, but not enough. And what everybody I respect agrees is that in order to have a hope of bringing Putin to the negotiating table, we need a mixture of tougher sanctions and also increased arms deliveries to Ukraine. Now, the sanctions at the moment are incredibly porous. Since Trump came in, he has eased many of the sanctions. It is now possible for Putin's friends, Russian oligarchs, to do major business in the United States with no chance at all of facing any serious trouble inside the United States. So Trump's made that easier. In London, I'm sorry to say, I remember being shocked when a very senior Bank of England official said to me years ago, well, of course, London is the money laundering capital of the world. Not much has changed since he said that to me. But today, the Russians can still move huge sums of money through London because those sums are too important to turn away. And I'm afraid we're all hypocrites about this. We all keep saying that we're determined to sanction Russia, and yet sanctions are incredibly porous. So if Ukraine is to be saved, and let's be in no doubt, Ukraine is in a very bad spot at the moment, with Putin piling on the pressure to try and get a victory this year. We've got to get tougher with Putin. We've got to give more support to Ukraine, and today it's not happening.
Max, thank you so much for joining us. Good to speak to you. Bloomberg opinion columnist Max Hastings with thoughts then, Valerie, on where the NATO defence narrative goes from here.
Yeah, now let's look ahead to some catalysts later today. U.S. Federal Reserve is going to release results from its annual bank stress test after the bell. Bloomberg's Charlie Wells is here with a preview. Charlie, what is the outlook for these results?
So look, Val, if history is any guide, all of the 22 banks that have been subject to this testing will probably pass. There really hasn't been a notable failure in these stress tests since 2018 when the U.S. arm of Deutsche Bank failed. And so what tends to happen is they pass, they finally get some clarity on what their capital requirements are going to be, and then they can start doing the things that, of course, investors love, which is talking about dividends. Now, Bloomberg Dividend Forecasting has been thinking about this, has been projecting this, and they actually see U.S. banks in the third quarter increasing dividends by 7%. And in a lot of ways, that's because these U.S. banks are incredibly well capitalized, right? If you think about J.P. Morgan, CET1 ratio is, or CET1 surplus is $56 billion, 3 times more than Bank of America. So a lot of capital.
And briefly, Charlie, how is the Trump administration looking to change the stress testing then?
They're looking to lighten it, right? So Michelle Bowman, recently installed as a top banking regulator, they're looking to get more transparency. That's what banks want. That's what a lot of investors have been thinking would happen earlier this year. It's taking a little bit more time, but it's looking like it's moving in that direction.
Okay. That's enough stress for a Friday.
Let's move on from the stress. Charlie, great stuff. Thank you very much indeed. And talk about what we've got coming up over the weekend. Anna's going to see the F1 movie.
Yes, I am.
She's very much looking forward to it.
I am not doing any of the other things that are on this graphic. I'm not going to Jeff Bezos' wedding or Glastonbury.
Or the Austrian Grand Prix.
Or the Austrian Grand Prix. Or the Roskilde Festival.
Anna's been talking about F1 all week, and everybody assumed that she was going to the Austrian Grand Prix. It turns out she's going to the cinema.
My bar for excitement seems to be pretty low, basically. A night out.
Glastonbury?
Movies is enough.
Anybody going to Glastonbury?
Yeah, I'm too old for that.
Oh,
I am
no.
looking forward to these photos from Jeff Bezos' weddings, though. You know, Americans abroad love to ham it up.
Venice is
Charlie's
enjoying
familiar
it. Venice is loving this experience.
Well, they hate it and they love it. I kind of love the drama on both sides, right? You've got these protesters kind of predictably not happy that a billionaire is coming and basically renting out their town. But also you've got all these celebrities coming, and it looks like it's a fun wedding. And also Venice is a place where people have extravagant excess. They've done it for centuries.
Yeah, but there have been protests, haven't there?
Yep. Venice is one of the epicenters of the over-tourism story.
Yes.
And the resistance and the pushback that we are seeing in a number of European capitals, Barcelona,
Did they
Venice.
rent out the whole city?
See, I'm glad you
Kind of felt like it.
I'm glad you took us there because I was struggling for a news link and I was going to take us back to US taxes and OECD tax, and that's not really.
I can take it back to the dollar if
That's
you really want.
that's not really what we're going for in the
Americans
States
turning up with lots of
Charlie.
dollars.
But the revenues, I think it's going to be something like 40 million euros for this town. The politicians really love it. The businesses love it. There's all this stuff about caterers getting a lot of business from this. This is beneficial for
Let's
Venice.
hope it doesn't sink.
That's the American point of view. Yes.
From the weight of all the large Americans on it. There we go.
I did not say that, Valerie. That's
We
not
can say
what I
that.
said.
Val, you and I can say that.
They're on safer ground.
The movie's going to be great. So we'll
Yes,
take it.
exactly. That's why I keep my excitement to low levels. Thank you very much to Charlie. Thanks to Val for joining us this morning. That is it for the opening trade. The Pulse is up next. European equity markets continue to move higher. This is Bloomberg.